If you are new to the stock market, you would have heard the term dividend a lot. Or you would have seen headlines like this where some big companies like Maruti or ICICI Bank or Tech Mahindra announce their dividends. So when we see all this, we get a lot of questions in our mind. What exactly are these dividends? Which companies give out these dividends? How do we find those companies? Should we invest in those companies? Well, in this video, we will answer all these questions using practical real life examples. But before we get going, if you're new to this channel, do not forget to subscribe to get more awesome videos like this, videos related to investing and trading in the Indian stock market. Alright, let's get going. So as an investor, you have two ways of making money. First is when the share prices go up. So if you bought a stock at let's say 100 rupees and the share price goes to let's say 150, you made 50% returns on your investment. This is like the most obvious way of making money, and most of us come to the stock market to make money that way. This method is also called capital appreciation. But there is one catch here. See, the profit that you're seeing right now of 50%, that profit is only on paper. It's not real money. It's unrealized profit. For example, here, this is my portfolio. So I'm sitting on all this profit, right? But all this is unrealized profit. This is just like Maya, an illusion. Because I can see all this profit right now, but what if the market crashes from here, right? So all these profits can go away in front of my eyes. So the limitation of capital appreciation method is that the shares have to be sold in order to see the money in your bank account, and up until then the profits will only be unrealized. But the good news here is that there is another way of making money in investing where you don't have to sell the shares to make money, and that is through dividends. So what are dividends? So in a very simple terms, dividends are the profits that the companies share with their investors. So you see, what happens is that when a company makes profit, the management of the company has to decide what should they do with that money. 100 crores, 1000 crores, right? These guys make a lot of money. So what should they do with that money? Well, they have two choices. The first choice is to reinvest the profit in the business, hire more employees, build more factories, add new product lines, expand into new countries. So do something to grow the business. And the second choice is to distribute some of that money to their shareholders, right? So the management can say that we don't really have any aggressive plans for expansion this year. So why don't we just distribute this profit among investors? So this profit right here that is distributed among investors is called dividends. Let's take an example to understand both the capital appreciation and dividends. So I am an investor in Britannia, right? I'm just picking one of the stocks from the portfolio. So my capital invested in Britannia has appreciated by 50%. But as of now, this profit is still unrealized, right? So the profit that we are seeing right now is unreal until I sell these shares. But the problem here is that I'm a long-term investor in Britannia. I don't want to sell these shares. So does it mean that I have to wait for several years before I can see any money from Britannia? Not really, because as an investor of Britannia, I also keep getting regular dividends from the company. Last year, I got this email from Britannia. So the good people at Britannia told me that, dear Venkat, you have been an awesome investor of this company. So we are rewarding you with a dividend of 83 rupees per shares. So 83 rupees. So let's see, I have 26 shares of Britannia. So 83 multiplied by the total number of shares, that is 26, that is 2158. That is exactly the amount of dividend that I received from Britannia. So that adds up, right? And I didn't even have to do anything because these guys just directly transferred the dividend to my bank account. And not just Britannia, I got dividend from all these companies last year. And I'm not the only one who loves dividend income. Take Warren Buffett, for example. He also has an affinity for dividend yielding stocks. And in the last financial year, he is reported to have collected almost $4 billion from just these 6 companies, right? That is the power of dividends. So let's go over all the reasons why investors such as Warren Buffett, they love dividends so much. Number 1. Dividend is a passive income. As you saw in my case, I literally didn't have to do anything to get money from Britannia, right? I just get an SMS or an email that this and this company has transferred dividend to my bank account, and that's it. Use the money whichever you want. Reason number 2 is dividend can be a steady income. Many retirees and conservative investors, they look for dividends as their regular source of income. Reason number 3, which I think is very important, is that through dividends, we can make money even when the markets are down. So you see, what happens is that in the bear markets, when the share prices are down, we are not making any money through the capital appreciation. But even in those kind of markets, many of these dividend yielding companies, they still give out dividends to their investors, and that is why the investors stay happy. So these are all the reasons why dividends are so popular. In fact, investing in dividend yielding stocks is identified as a separate branch of investing called dividend investing. And some investors even identify themselves as dividend investors. But there is one thing to note here is that the culture of dividend investing is much more prevalent in the developed economies such as US and Europe. Indian companies have been a little conservative in sharing their profits in the past. I think they are getting better though. Some companies such as Hindalco, they have opened their wallets and shared more profits with their investor. So I hope that other companies would follow suit and share more dividends with their investors. These are some other examples of high dividend yielding stocks. So guys, so far we have seen all the nice aspects of dividends. Now it's time for us to look at some of the disadvantages of investing in the dividend yielding stocks. Number one, high dividend yielding companies have lower growth prospects. Remember the dilemma that the management has whether to reinvest the profits or to distribute the profits among investors? Well, I would love to get dividends all year long. But at the same time, I should ask this very important question that if the company is distributing the profits, doesn't it mean that they are out of ideas as what to do with that money? Why are they not using that money to build new factory? Why are they not spending money on R&D? Why are they not adding new product lines? Why are they not expanding into new geographies, right? So clearly it means that the company which is giving out high dividends is not having very aggressive growth plans. And the reality is also very much like this, right? So all the high dividend yielding stocks, they are typically large cap companies with a very stable source of income, right? So they are leaders in their sectors, they are established players, but at the same time, they also have lower growth prospects. And that is exactly the reason why they are giving out dividends rather than reinvesting the money in the business. Number two, a high interest rate environment can cause investors to sell these stocks and put their money in safer instruments such as bonds or fixed deposits. See, a lot of these dividend investors, they are looking for some kind of a stable returns, right? And since they don't get this kind of returns from their banks or FDs, they are putting their money in these dividend yielding stocks. But what happens if the interest rates start to go back up, right? So if their bank starts to give them 8% returns or 10% returns, would it not make sense for them to sell these stocks and put their money in the fixed deposit, right? So there they can make money without taking any risk. So this is exactly what happens. In a high interest rate environment, we see that these high dividend yielding stocks, they underperform because investors pull the money from these stocks and put them in safer instruments. Point number three, there is always an uncertainty regarding the dividend. See, the companies that give out dividends at a more or less predictable rate, but sometimes due to maybe the change in management or changing some of their policies, the dividend rate can be cut. So it is quite possible that a company that you invested in the hope that you will make some good dividends, may start giving lower dividends or no dividends at all. So you have to be prepared for that scenario. Okay, so those were the pros and cons of dividend investing. Now let me ask you a very interesting question. Let's say that I have invested 1 lakh rupees each in two companies, company A and company B. And both of them give me dividend of 10 rupees per share. So can we say that both these companies are giving the same dividends? The answer is no. Because even though I have invested exactly 1 lakh rupees in each of these companies, we don't know how many shares do I own for each of these companies. So if the company A's share price is 50 rupees, I have 2000 shares of company A. And if the company B's share price is 400 rupees, I have only 250 shares of company B. Now with this piece of information, it becomes easier to compare. So for company A, I will get 20,000 rupees of dividend, whereas for company B, I will only get 2,500 rupees of dividend. So the reason I brought this point up is because a lot of investors, they look at the dividend per share announced by the company. And when they see a big number, let's say 100 rupees or 200 rupees, they think that the company is giving very high dividend. Whereas in reality, what we have just seen is that the absolute amount of dividend per share doesn't really matter. We need to use a metric called dividend yield, which is basically the ratio of dividend per share divided by share price of each share. So when we compare the dividends of the company based on dividend yields rather than the absolute amount itself, it makes much more sense. Now it's time for us to answer some frequently asked questions about dividends. Number one, how to find the companies that give high dividends. So there are a lot of websites where you can find this information, but I like screener.in, where they already have built a scanner like this. So basically you can come here and you can see the highest dividend yielding shares. And at the bottom here, they also give you the flexibility of adding some more criteria. so that you can refine this list based on your own custom conditions. So do check it out. Number 2, at what frequency can investors expect dividends? Is it given out weekly, monthly, quarterly, or what? Well, usually dividends are declared annually, that is once a year, and they are called final dividend. But companies can also issue interim dividends during the year. So there is no hard and fast rule that it has to be only once a year. In fact, companies like MRF, they have even declared dividends 3 times in a year. Question number 3, how much dividend can we expect typically from an Indian company? Well, the dividend yield actually varies from company to company. For some companies like Oil India or Power Finance, the dividend yield can be as high as 9 or 8. But for some other companies, such as let's say Power Grid or Britannia, for example, can even be as low as 4. But what you guys really have to understand here is that companies are not obligated to issue a certain fixed amount of dividends, right? Just because a company has issued high dividends in the past doesn't guarantee that they will keep giving you that high level of dividends, right? So don't expect a company to keep giving you high dividend every time. In fact, they are not obligated to issue a dividend at all. So guys, we have covered a lot of information about dividends in this video, but I would like to wrap up this video with 3 pieces of advice. Advice number 1, don't invest in companies just for dividends. See, a lot of people, they get so much fascinated with dividends that they forget about the main reason that we invest, which is capital appreciation. Right, so I will give you an example of IOCL. So IOCL is known to give very high dividends. But if you take a look at the chart of IOCL has done nothing but disappointed its investors, right? You can see how far it has fallen in terms of the stock price. So if dividend is your only criteria for looking at the companies, you might get stuck in a stock like IOCL, where your capital, instead of appreciating, will depreciate in its value. Advice number 2, consistency of dividend is very important. So if you are looking out for a company to invest from a dividend perspective, you should not just look at the last year's dividend, you should also look at the consistency of the dividend in the past 5 to 10 years. And my last advice is, have a balance in your portfolio between dividend stocks and growth stocks. You need to have some stocks which are giving you stable income like dividends, but at the same time, you need to have some stocks in your portfolio that may not necessarily give you dividend, but they will give you growth and capital appreciation. So guys, this was our first video where we covered a lot of important points regarding dividends. But there is a lot more to dividends than what we have discussed in this video. So if you guys are serious about learning all these aspects of dividend investing, let us know in the comments below, like the video, give us feedback, let us know that you want to learn, because if you are serious about learning, we are serious about sharing.